Hello everyone. Very good evening. I, Neha Pritmani, welcome you all to this webinar. First of all, I will wish you all a very happy and a prosperous new year. Today's webinar conducted by ICAI is on scanning the risk horizon and internal audit perspective. This webinar, the speaker of this webinar is CA Vijayalakshmi Suresh. She will be providing us insights on the internal audits. If I talk about CA Vijay Lakshmi, she is an eminent speaker for our today's webinar. She is a finance professional with around 30 years of experience with and she has worked with many MNCs like Tata Group, Shell, and Coca-Cola. Also, she has worked in multiple sectors, including engineering, consumer goods, and media. Her domain experience is in corporate finance, treasury, taxation, internal audit risk also. C. Vijayalakshmi is also a mentor and coach, and she has conducted various trainings for finance and non-financial candidates on the topics of corporate planning and code of ethics. Welcome, C. Vijayalakshmi, for this webinar, and we are grateful to have you with us today. Thank you. You can start with the webinar.
Thank you, Neha. The pleasure is always mine to address the eminent chartered accountant community. First of all, wishing everybody who is attending this program and their family and their dear ones a very, very happy, prosperous, and joyous 2025. It is really heartening that people have taken time out on the first day while most of us would be thinking of celebrating. So, this shows the commitment of the CA community for continued learning, and I do hope I'm able to provide some useful insights to the audience. Uh, I will, yeah. Is my screen visible?
Yes, yes.
Yeah, thank you. So today's topic of the webinar is scanning the risk horizon from an internal audit perspective. Uh, Internal auditors, we have always heard of the term risk used by internal audit professionals and across, whether we read a newspaper or we watch television or we read a business magazine, risk is a word that keeps coming up time and again. And we also know that there are dedicated risk professionals, and risk is a career in itself today. So, what is risk and why is it so closely intertwined with internal audit? Because most of us know the internal audit subject matter and the domain expertise. But how do you link internal audit and risk? So, this is what we're going to see in today's webinar. We will take this up into three parts. First is the traditional enterprise risk management as we all know it. What the second part would be, what has changed so much in today's day and age, what has changed so much in 2024, what has changed post covid so much in our lives that things have actually turned upside down in several areas. Lastly, we will see that now that the landscape has changed, how do we as chartered accountants, how we as internal audit professionals gear up ourselves? How do we adopt and fine tune our strategy to make sure that we are relevant as the world keeps changing around us, we also change accordingly. Yeah. So we start off with what is enterprise risk management. Risk is something that is inherent in everything we do, the types of the roles that we undertake, and there are very diverse kind of risks. And what is enterprise risk management? It's a very integrated and joined up approach to manage risk across an organization and its extended networks. So when we say across an organization, we could be talking of a bank or an insurance company or a manufacturing company or a trading company or even an e-commerce platform. So any organization will need to have a risk management framework, and it is not only within the organization, whether it is a small partnership firm or a very large conglomerate. It is very important. And not only it is contained within the company or the organization, it also pervades in its extended network. So not only it is for a company, it is also for the ecosystem of the company, which could mean the government authorities that the company deals with, or its extended vendor supplier network, or its customer network, or its service providers, or third parties that support the organization. So, risk is there in every aspect. It is not just within the company, it is also outside the company that will impact it. So, when we say enterprise risk management, so at an enterprise level, enterprise means holistic. So, it is not restricted to one geography or one factory or one branch or one warehouse, nor is it restricted across functions. It is not that enterprise risk management is only for finance function or it is only for the operations functions, whether it is operations, finance, HR, strategy, the costing department, treasury, everywhere ERM is spread out. The one main feature when we say enterprise, it means it has to be aligned with the corporate strategy. As we all know, it is the board of directors of a company that oversees risk. So when we look at risk, it should be aligned and it should be part of the corporate strategy, which means what the company wants to do in the next 3 5 years in its corporate plan is should be tied and aligned with the risk. It should not, risk and strategy should not be divorced from each other. Second, you should also have a risk strategy and governance. So, one, the first of all, the organization needs to have clarity on driving risk management. Second, like we know, many of us know that most organizations have an internal audit charter. So, for listed companies, you might actually go to the company's website. The audit committee, the audit charter is put up there. Like an audit charter, the company should also have a risk charter. The ERM objectives, the risk management objective should be defined, and the risk management roles should also be specified and understood. And the company should also have a structure, an organization structure, and the processes that are there should support risk management at enterprise level across the company. So, this is the E of enterprise. Now, coming to the risk. So when we say risk, for different people, it means different things. For some people who are by nature very scared or risk averse, even crossing the road could be a risk. And then there are people who fly into space. So how do we define risk? It's very, very important that the risk management terminology and definitions are clearly articulated in the framework. So, the company should define in its risk policy what it defines as risk, what is likelihood, what is impact, and the various categories in which the company looks at risk. And in terms of enterprise risk assessment, so once you know and you have defined the risk, the next step would be assess the enterprise level risks. So if there is something that is affecting one small part of a company or a small part of an organization, it may not qualify for enterprise risk definition. Something that will affect the company across the board is what we call an enterprise risk. So these risks are inventorized. So we have to prioritize and focus on risks that matter most to the company. So we cannot, obviously, when you look at a very large organization, you would have hundreds of risks across different functions, across different categories. Not possible physically or practically to assess and address all the risks, but we need to prioritize which are the top 10 risks for each business, which are the top 10 risks for the organization as a whole. And once you prioritize, then those risks are addressed and they are continuously assessed. So we now understood what is enterprise, what is risk, and now how is this enterprise risk managed across companies? So typically, most organizations have something we call a risk response plan. So these response plan are towards protecting, detecting, and mitigating. So you could have plans that will protect the organization from the risk, plans to detect the risk at an early stage, and plans how to mitigate those risks. Finally, it once you do all of this, it is a continuous process. It is not a one time pill that you say, okay, I define what an ERM is, I establish my framework, I have the policy, I do the assessment, and then what? On an ongoing basis, you have to continuously monitor those risks, which means just like all of us would have heard of KRAs, which are key result areas for a company. You also have key risk indicators, which are called KRIs, and these are regularly monitored on a monthly, quarterly, half yearly basis. and reported to senior management and the risk committee and the board of directors, so that this is monitored properly, this is addressed properly, and then we continuously calibrate these risks. Most of us have seen this is a very typical ERM approach that we have seen in organizations. First is the risk management framework. So, this involves reviewing the existing risk management processes, prepare enabling frameworks based on existing documents and discussion with the management. And we document the risk management processes, enablers, and policy for the company. So, these and typically the output of that, we will see what the deliverables are. The next step would be identification and prioritization of the risks. Based on the industry, research, and discussions with the key management personnel and board members, risks are identified and these are prioritized based on the impact and the frequency. How frequently this risk can occur, and what is the consequence if the risk occurs. If it occurs, will it have a very large consequence or will it have a very small impact? And support prioritization of the key risks that matter, the top 10 risks or the top 15 risks in each area. So we have a risk framework in place. We have identified and prioritized our risks. Now, what is the third step? For the activities related to risks that matter, the critical risks of the company, we need to define KRIs to assess the status of these activities. So, key risk indicators. So, some of these could be lead indicators, some of these could be lag indicators. So, these indicators are uh, these will indicate to the company how it is progressing or performing on those risks, and what are the management's views on improving, or in case this occurs, what should be the mitigation plan. A BCP, typically a business continuity plan, as most organizations would have, is a very typical mitigation plan that in case some disaster occurs, in case there is a flood in the main factory of the company, how does one ring fence the risk, and how do you continue business as usual, and how quickly you can come back on your feet. And the monitoring framework, so we also need to establish a monitoring framework which continuously monitors the risks and how the company is performing on those risks. These are the four typical steps that you do, and the key deliverables, the outputs that we see. The first would be a risk management framework for the company. Second would be a detailed risk register with identify risk that matters. So when you draw up a risk register, you actually sit with the business owners and the process owners, detail out those risks, understand what is impacting or what could potentially impact the business, what is the likelihood of that happening, assign values to that if possible, and draw up a risk register. So typically a risk register is reviewed every 6 months depending on the industry. If you are in a very dynamic industry, it might make sense to do it on a quarterly basis as well. And now you have a risk heat map, and you also have a mitigation plan that says that for these risks, these are typically the risk owners, and these are the people responsible for the risk, and if it ever happens, this is what the steps that they will take. And we also have a dashboard for continuous monitoring, and this risk dashboard is published to senior management of the company, like the CHRO, the CFO, the CEO of the company, the business unit heads, and eventually for listed companies, the risk committee and the board of directors. Risk score. So, the risk score is typically you have the likelihood categories that we need to consider. So, the likelihood is graded. So, you can have a scale. This is a very typical scale. You can also modify it to suit your organization's requirement. So, if it is rare, it means that this risk is not likely, it's almost impossible to occur. Between 2 to 3 years, you don't see that this risk will ever happen in the near future. Second, the next category would be it might occur once or twice in the next 2 to 3 year horizon. Third is it's a possibility. So it is a definite possibility that this risk can happen once or twice in the coming 1 year. Above that, a higher rating would be likely, that it's not only possible, it is definitely likely that it will happen once or even more than once in the next 1 year. and the highest rating would be almost certain, very, very high probability that something will happen. For a company in the financial services industry, a monitorable could be how often would RBI change the interest rates. So if your industry or your company is sensitive to that rate, so this is something that, so you need to assess how likely it is that RBI will change the rates in its monetary policy committee in the next 12 months. Will it change twice? Will the rate go up, or will there be a rate reduction, or will the rate be kept constant? So what is the probability? So this probability is something that we need to assess. A lot of it is intuitive because you're trying to predict the future. Second, so while we spoke of probability or likelihood, on the top axis, you can see a consequence rating. We can also call this the impact. So, what happens to the organization when such a risk actually becomes a reality? Risk is something that is a probability, but when it happens, it becomes reality. So, do you have a very small, insignificant impact or a low impact, which is indicated in green, as you can see? The impact could be a minor impact, could be a minor disruption in one part of the organization, that's marked in yellow. You could have, when the risk actually occurs, let's say a fire in the key factory of the company, of the organization, that is a major risk, because this could disrupt operations, say for 2 weeks to a month, and it would imply loss of sales, it would imply loss of inventory, it could be a financial loss. And while you are trying to come out of the setback, it is quite likely that competition runs ahead of you. So this is a major consequence. And extreme consequence is something that would cripple the business, where it's also likely that unless the mitigation plan works, you might, the profits might get eroded, or the company would run into a loss, or even the very existence of the organization might be threatened. So this is typically what you see on a 2 by 2 matrix, and most of us would have seen this is called the risk heat map. On the right hand side is what has come a little more recently, where we call the speed of risk or the speed of impact. What is the speed? So when you look at 1, 2, and 3, we have put down three categories. Low speed, it means that this risk is not likely to impact the company for some time, but you should monitor the velocity. The moderate speed is something that can have a potential short term impact. 6 to 12 months, it can potentially impact the company. High speed risk is the moment the risk becomes a reality, the impact will be almost immediate. And so these are issues, or these are risks that has to be addressed immediately. So risks will have immediate impact, medium term impact, and long term impact, or there could be some which could have both. So when you assign a risk score, it is a product of the consequence rating and the velocity. So where you are here on this matrix, multiplied by the rating that you assign to the speed, how quickly you see it impacting. Would it impact short term, medium term, long term? So this is typically how risk scores are done. And based on the risk scores that you give, you could have some things which will have a very high extreme impact. But if you believe that this will not affect the company for almost a year or beyond that, then it will have a low velocity. So when you multiply the consequence rating and velocity, you will actually get a proper risk score. And once you score all the risks or all the major risks, and you draw up your top 10, 15, or top 20, that gives you the risk register to work upon. So that is your starting point. So, some of the impact categories that we can consider, the entity is subject to different kinds of potential events and situations. So, this will stop the entity from reaching the goals in different ways. So, each organization will have different business goals. It could be strategic goals, it could be goals of having a certain top line, having sales growth, profit growth, market share, and market share being the number one or number two, achieving share price growth. All of this could be the strategies of the company. And the risk can impact in different categories. It could have a financial impact. So in financial impact, you can see that an extreme high impact would be impact on the P&L, loss of sales, costs, etc. a substantial impact on the P&L or the balance sheet of a company, or you could have a medium impact on the P&L and a low impact on the P&L balance sheet. Business disruption. So at a extreme level, you could have the entire business is disrupted, or you could have one or two business units that are disrupted, or you can have a disruption in a small pocket, or you can have a minor insignificant disruption which will not have any material impact on the financial of the company. Similarly, when you look at regulatory impact, so if there is a risk in the regulatory domain and it happens, you could have fines from regulators like Reserve Bank of India or SEBI or IRDA for the insurance companies. So a regulatory impact could be that the company could be slapped with a fine, the license could be revoked, it would not be allowed to function in its operations for some time, for a limited period of time. So this also causes a reputational damage to the company, and the relations with the government and the regulatory authorities will go sour, and this company will be on the watch list of the regulators. So that's an extremely tough situation. The substantial could be that, there could be a regulatory impact, but it could not be so severe. And if there are minimal regulatory impact either on the organization or on the board of directors or on the operations of the company, so these are good to have, but any kind of regulatory violation should always be avoided. Reputation risk, if there's something that goes wrong, the company's market reputation gets affected. So it gets wrong press in the media, there is negative mention about the company, and or it's the company is ignored by the media. So this also impacts the stakeholders, the shareholders, or even the potential shareholders. For instance, if you have financial institutions or mutual funds that consider investing in this organization, if there is a negative reputation impact, they will withdraw, they will not invest, and the company's ability to raise funds gets severely affected. Market share, again, to what extent your market share gets affected, whether it is long term or short term or mid term, and how long the organization takes to recover the market share which it originally enjoyed. And finally, strategic impact, it could be changes in senior leadership. If the board members change, if there is an acquisition and there's a change in the board members, or if there is a change in leadership, there is a transformation exercise, the entire leadership changes, or the operating plans and the strategy changes, how the company wants to grow in the future, if that strategy changes, then these are strategic impacts. So some of these risks will have strategic impact on the organization. So not only do we have a risk score, we also need to consider which category the risk can impact and how severe the impact is going to be. Most of the leading companies, we find that they embed risk into their performance management practice. So earlier we would have a compliance centric, so we would have risk identification and reporting. The historical focus would be on independent risk identification and assessment process. You would have risk management designed to provide risk reporting to leadership and board. You have processes independent of operations and performance management, and evaluation of the current exposures. So whatever exposure that the organization has, it could be exposure to a liquidity risk, it could be exposure to maybe foreign currency. If the company is a major exporter, then the way the dollar moves could significantly impact. Based on historical perspective, how do you evaluate the current exposure of the company? And it is more compliance focused, that whatever is required, the organization has to comply, whether it is with the Companies Act or with SEBI or with RBI or with the other regulators. I should be 100% compliant. So this has been the historical focus. It is more preventive. It is in a little more inward looking, and it is at the basic starting point. So from compliance centric, this again, the objective is value protection. So how do you protect the value of the organization? There should not be any reputational risk, etc., which will erode the value of the company, which would erode the market capitalization. So this has been the historical focus. Now moving from here, today the perspective has changed completely. Today risk is actually used to enhance the performance management. Many leading practices in this area would be: you integrate risk and performance management. Do not look at the operating performance of the company separately from its risk performance. The two have to be interlinked. Aligned with the P&L and balance sheet, enabling risk adjusted real time decision support, which means that the big ticket items on the P&L, the large assets and liabilities on the balance sheet of the company, identifying risks and enabling the company to take proper risk based decisions. This would actually empower the company or enable the company to make superior quality decisions. Define future trends and predictive indicators. Instead of going only by the past, what has happened historically, look at predictive indicators. Many companies today, or even at government level, they look what is happening in India today happened in Singapore 15 years back, or happened in Thailand or Malaysia 15 years back. So how did those countries grow? How did their, say, public infrastructure grow? So what happened 10 years ago or 20 years in US, they say would happen in India today. So use that to predict and have predictive indicators rather than only looking at the past. Also build scenario analysis and stress testing. Stress testing, we have learned, we have seen often happening in the banking sector. But allow scenario analysis. So what happens? So you not only build a business plan. For every plan that you have, always have a base case, have an optimistic case, and have a pessimistic case also. So the company organization would move from value protection on the extreme left to value creation on the extreme right. And you're going to shift focus from historical events to future predictive indicators. So this is how leading companies, and one could be anywhere on this arrow. You could be at the bottom or you could be at the top. It's a journey. You'll have to start from the bottom and raise your way towards the top. So now we saw risk categories. So all of these various categories of risk, they make up the risk universe. So this what I have given, it looks like a very complicated galaxy, like a sun surrounded by so many stars and planets. But in real life, this is only a small snapshot. Reality is far more complex than this. So we can group risk into four categories. You have strategic risks, compliance risks, operational risk, and financial risks. All four together constitute the entire risk universe. So if you come to the strategic risk on your left, extreme left, you can see you could have governance risks. You have seen some of the organizations that have been real great and that have been acclaimed or acknowledged as the number one, the number two players in their respective segment. They have vanished. Uh, Satyam Computers, if many of us would recall, was awarded the Golden Peacock for governance the year before it collapsed. Likewise, a blue chip organization like Yes Bank, it was a very large private sector bank in the country. But yes, due to governance issues, it came from number three, the private bank number three, to where it is today. So governance can actually make or break an organization. So this is a strategic risk for the company. Planning and resource allocation, risks associated with planning. How do you have, with limited resources, how do you allocate your resources to meet your short term, long term goals? Mergers, acquisition, divestitures. So this could happen for the company and this could happen by the company, which means that you could have the company planning to do mergers and acquisitions, divesting businesses or divesting part or whole of a business unit, or it could also be that some other organization in your industry or sector could be thinking of acquiring your company or a division of yours, which would also impact the organization. Market dynamics. Some of the market dynamics are really fast changing, especially most of us would have seen in the e-commerce sector with the new companies, new age quick commerce platforms like your Blinkit, like your Zepto, like your Swiggy. Are they going to impact your traditional kirana stores? We don't know. We have to wait and watch. Government policy. So, government through its policies gives encouragement, fiscal encouragement to certain sectors, to certain industries where the government focus is sharp. So, if there is a government policy that encourages this particular sector, quickly it could come to your mind that EV or green is something that the government is focusing on, and a lot of incentives are given for the EV ecosystem. So, are you in that industries or are you in an industry that uses coal? So, will the government have a policy of phasing out the traditional sources of energy? So, these are some of the considerations that the organization should have. Investor relations and communication initiatives, these are also strategic. So this is strategic, it affects the whole organization, and it the risk would have a short term and a fairly long term impact. Now let's come to financial risks, which are outlined in green color. So you could have accounting and reporting risks, that the company is not reporting the right way, not following the relevant accounting standards. You could have liquidity risk and credit risk. Uh, so if it's a company that requires a large amount of, let's say, working capital, then not having adequate money in the bank, not having liquidity would cripple the business. Likewise, credit risk. You could also have market risks, capital structure risk, how the company is going to raise funds, whether it will raise funds through debt or through equity or through a mix of both. Events that will happen in the financial sector that will affect the way the company will raise funds. So these are some of the financial risks that are there. Operation risks, these are the day to day operations of the company. All the physical assets of the company, the manufacturing plants, any risk to the manufacturing plants, the tax operations, the IT and cyber infrastructure of the company, the people and human resource assets. So these are all the assets of the company. How the company manages the supply chain operations, whether it manages on its own, whether it has third party logistic providers, product safety, and customer expectations, and sales and marketing. So these are some of the operational risks that you have. Another point that one can think of is client concentration risk. Uh, or you could also have geographical risk, where if 80% of your company's revenues come from one single business group or one single government company, are you at risk? Most certainly you are, because tomorrow, if that company decides not to do business with you, what percentage of your revenue goes down? 80% goes down. So that's a very critical risk. Second, you could have geographical concentration, where if you look at the balance sheets or the annual reports of IT companies, large IT companies, you would say that's something that they are very, very aware of and vigilant, because you could have a geographical concentration where if it is your clients are concentrated in the geography of USA or in Europe, you could have different implications for a company that has significant amount of exports, let's say, into Europe. Then if Europe goes into recession, or the economic growth or the GDP growth of Europe is very low, then you could get affected. If your company's main customers are in the United States and you get 80% of your revenues and profits from USA, then a change in the president of USA can also affect you. The change in the policy, the trade policy of the US government, will have a make or break effect. So these are some of the concentration risks that we see. Lastly, on the compliance front, you could have a code of conduct that the company has. You could have legal and regulatory legal compliance. You could have product recall. You could also have regulatory compliance. So these are largely the four buckets of risks, and under each of these areas, you could keep on adding to this also, depending on what is relevant to your industry and your organization. So this is the entire risk universe that we are talking about. So typically, you have multiple risk categories. Governance will have board performance, tone at the top. How does the board of directors of the company look at risk? Do they look at risk seriously, or do they just think that, oh, it's just a business slang and let's be done with it? CSR. Is that a risk? That's also part of the governance. So you have planning and resource allocation. Under mergers and acquisitions, you would have valuation, pricing, due diligence, market dynamics. So here also there is a risk at the enterprise level. You have government policy and market dynamics both impacting the organization. It could be from extreme competition. You could have pricing pressures. You could have lifestyle trends, macroeconomic factors, socio-political factors, all of which affect the marketplace. Communication and investor relations, media relation, crisis communication. Say when COVID hit, all of us, how did the government respond? What was the employee communication that was done? And how do you have the people, how do you boost the morale and maintain the morale of a people? And India, as a very large country with the largest population in the world, did exceedingly well both in communication and in crisis management. Which are the major initiatives of business? How do you measure and monitor those? How do you implement the latest technology? You have code of conduct, ethics, and frauds. So this is another big area which we as internal auditors always look at very closely. You could have under the legal universe, you will have contract risk, intellectual property risk, anti. How do you implement anti-bribery, anti-corruption? And regulatory, there are so many regulations that you come up with. You could have trade regulations, you could have customs laws, labor laws, securities laws under SEBI, environmental laws, data protection, health and safety, tax compliance. So many regulatory risks are there. Moving on to operations, you will have on the sales and marketing front, you will have marketing, advertising, R&D, pricing, customer support management. These are all the areas where you will have different types of risks. Supply chain. How do you do your master planning and forecasting? How, based on your forecast, how do you plan your procurement and inventory management? How do you do your production? How the goods are transported? Do you have a main mother warehouse and you have distributed warehouse management, or do you have a single large warehouse and and move your goods directly to the customer selling points? How is the distribution managed? So depending on the operations framework, the company will be subject to varying kinds of risks. People and culture, again, what is the culture of the company? What is the tone at the top? What are the policies for recruiting and retention? Does the company have a succession planning? So this itself is a big risk. You have seen, and we have actually seen very large industrial houses. Suddenly you find that the patriarch or the chairman of the group is no longer there, and there is a fight between the inheritors on who will succeed and who will inherit the business. So succession planning is a major risk. Comp and ben, are your compensation and benefits in line with the industry? Are you overpaying your staff, or are you underpaying? So that will also decide the quality of people that you will be able to recruit. How are your labor relations managed? So this is an entire gamut of people and HR. Hazards, you have natural events, you have terror and malicious acts. Physical assets, most companies have physical assets like plant facilities, the properties, real estate of the company, you hold inventory. These are all the physical assets. And then you have the tax operations. So all of these operational areas will have certain risks attached to them. So it is up to each one of us to identify the risk. So what is a risk? You might assess it. You might say, okay, this will have some impact on my organization, or this is a risk. It may affect the sector, but it will not affect my company. Or this is a risk. This is a very authentic and valid risk. This will have a significant impact. It will have a consequence in the short term and medium term, and I should have a mitigation plan for it. Moving on to the financial risks, we have seen market risk where you could have interest rate risk, foreign currency, commodity. So if you large number of industries, for example, the electrical segment, it's dependent on cable, and for cable industry, the raw material is copper. Copper is not something that is manufactured in the country. Copper prices, like gold prices, are internationally determined. So each of us, for example, if you're a company that depends on copper for its inputs. It's very, very essential that you closely monitor the copper prices on the commodity exchanges like London Metal Exchange, LME, and the other exchanges. Derivatives. Do you have derivatives? Do you use derivatives as a means to hedge your risks? Would you do forward simple plain vanilla forward covers, or do you get into complex derivative structures to protect your risk? Addressing liquidity and risk, you could have funding risk, cash management, credit and collections policy. Do I do bill discounting? How do you manage insurance? Because insurance is the biggest risk mitigation tool available for all of us for various kinds of risks. On the accounting and reporting front, we need to make sure there are adequate disclosure and there is reporting and information integrity, and that our accounting statements and financial statements and disclosures in the financial statements are in adherence to the accounting standards prescribed by ICAI, IASB, and so on and so forth. Similarly, how do you structure the capital? So if you look at one area, and this is just illustrative example, in real life you will find that you will have even more number of areas, and in those areas you might have risks that are not there on the screen, but that is definitely for each of us to consider in our risk universe. So typical risk, this is only a typical risk universe that we see here. Reality could be much wider. Yeah. Now you have the maturity. So now that you have a framework in place, how mature are we? How do we move up the maturity curve? So you could be, if you are at a beginner, your organization could be at developing, or if you are high up, if you are at the Mount Everest, you will be at the next gen risk assessment right on top. But no matter where you are on this curve, right, the organizations can always be more risk intelligent. So the key thing here is to be risk intelligent, and you should be able to create structures and processes which facilitate risk conversations. So you should have risk conversations, not risky conversations. So this maturity assessment, to understand where you are on this curve and to have an action plan to move up the curve, is very, very important. So this is again something that many consulting companies would be able to help the company in identifying, because in this maturity assessment, when you assess your own organization, you're not looking only just at your company. You need to look at your industry. You need to look at large, good benchmarks within your industry, benchmarks outside the industry, large Indian companies like companies in the Tata Group, Godrej Group, L&T, or Jindal Group, and so on. Or would you benchmark with multinational corporations like Unilever, Johnson and Johnson, large pharma companies, etc.? So depending on with whom you benchmark, you can say, okay, I am at the bottom of the curve, or I am somewhere in the middle, or I am at a good place and I am moving towards the top. So wherever you are on the maturity assessment, there has to be a framework or a path for improvement. So thus, so far, we have seen the enterprise, what is a risk, what is enterprise risk, how do enterprises manage the risk, what are the frameworks of risk management, what are the deliverables of the risk management framework. We also saw the risk universe and how wide and how broad it can be, and how any one small risk which actually translates to reality in one corner can actually impact the entire organization. For immediately it can impact over a longer period. So this was the traditional way of looking at ERM. So now we see, the question in most of our minds would be, okay, we have been doing some of this, we have been doing most of this, so what is the need for change, or what has changed, or what has become different? To understand this, let's take a moment. All of us would have seen or heard about the World Economic Forum. So here the world's top economic minds, the finance ministers, the who's who of finance and economics across all the leading countries in the world. So they constitute the WEF, And the WF in 23-24, they have done a global risk report. So risk affects all of us. It affects us as individuals, as family, risk to the community or neighborhood in which we live. Risks are there in the company that we work in, and risks are there in the country that we live in. So, what are the kind of global risks that across the world the various countries are facing? So this is the current risk landscape. So they were asked to, about 38 risks were identified, and you will see the color codes as we move along. You will see what these represent. So extreme weather, so far we have seen in the first 7-10 slides, we didn't see extreme weather anywhere, you know, uh, but 65% or 66% of the topmost minds of the world believe that extreme weather is could be a big risk. AI generated misinformation and disinformation. This is a very high risk because it is largely unknown. Most of us have some idea of what artificial intelligence is. We are seeing some, we are experiencing some of the capabilities of AI, but even most developed countries, we still have not seen the full capability of what AI can do. So it is a risk. Societal and political polarization, this is a big risk today for the community and the society. Cost of living crisis. Large cities in the world are becoming unlivable. A very classic example of this, if you, I am from a place called Mumbai on the west of India. Bombay, right from the British days, was the textile hub of the country. Bombay and Surat. So this was the textile capital of India. Large textile mills were there. But today, if you come and see in Bombay, half a kilometer from where I sit, all of these textile mills have run down. They have closed down large tracts of land, and the factories and the machines are just lying in the open. They have deteriorated. They are all closed and shut down. And the textile industry has moved out of Bombay to various other places like Surat, Kolhapur, Coimbatore, Vishakhapatnam, Kolkata, and so on. So Chandigarh, Ludhiana. Why has this happened? Primarily because there was a labor unrest, and it is because as a most expensive city, Mumbai and Delhi are the most expensive cities in India. So the cost of living crisis, when the cost of living of a place goes very high, it immediately results in very high wages. And because of the high wages, it makes unviable several industries, and hence industries have to shift from urban areas to other industrial hubs. So this is a big risk. Cyber attack is a risk. Economic downturn is a risk. For instance, if there is a slowdown in GDP growth, does it affect the sale of two wheelers? In fact, many of you must be reading of a K shaped economic recovery post COVID. What we see is the demand for luxury cars and super luxury cars like your Mercedes Benz, BMW. Those have gone up. There's a very long waiting list. The prices have gone up and the demand has gone up. But the sales of smaller cars like Maruti Alto or the base models, they have actually gone down. And for the last 5 years, from 2019 to 2024, the automobile industry in this base segment has shown zero growth. Sales of two wheelers have not increased. So this is one of the indicators, perhaps, of an economic slowdown for certain pockets, and this will impact in not only the automotive industry but also several industries that are part and associated or which supply or the OEMs of the auto industry. So economic downturn is something that we have to watch very carefully. Disrupted supply chains for critical goods and resources, escalation or outbreak of interstate armed conflict. So these are the top 10 risks. If you see, if you have seen the previous slides, perhaps one or two of these eight, 338, yeah, there are eight risks out here. Perhaps one or two you could have seen, perhaps cyber attacks in the earlier risk framework. You could have seen possibly economic downturn, where recession could be one of the risks facing the company. Yeah. So only two out of eight has been covered in the traditional risk management or ERM framework. Does this mean that the other six do not matter? Absolutely not. In fact, I had internal audit and risk in Voltas, and as you all know, this our company is a leading AC manufacturer in this country. It's the number one player in the market. What we have seen is earlier one would have a very good summer every 2 or 3 years. There would be an extremely uh, high heat summer, which would be very good for the AC industry. But now we feel, last couple of years back, we saw that every year there is a peak summer. Now we are seeing that sometimes in certain pockets of the country, you have 2 summers which are very, very high temperature. Some places suddenly you see that the monsoons have shifted from June, July to, it'll start in August instead of June, and it goes on right till November. You have extended winters, you have extended summers. So the climate has become very unpredictable. And it is not just for the people. Climate is not something that affects us, it affects industries like us. So the demand for air conditioners has gone up, which is why you will probably have seen in the marketplace that there are so many new players that have come up in the last 2 or 3 years because of extreme weather. So a lot of these risks are risks that we are not aware of, or we may be knowing about it, but we may not consider that these are risks that could have an impact on your organization and business. This is the reason why we are saying that in today's webinar that it should be, we need to scan the horizon. It is not enough to just look at your compound, your organization, or your factory. You need to stand on the rooftop and look across and scan the horizon till whatever you can see what is happening around you. Let's now look at what is the short term and long term global outlook. Yeah. So when respondents were asked in the next 2 years, do you see, the outlook was classified into stormy, ranging from stormy to calm. So you could have you could have a calm at global atmosphere. You could have stability, or you could have some unsettlement, or you could have turbulence, or you could have real stormy uh, risks. These are very, very high risks. So if you see, it is a little concerning to see that in the short term, the stormy and turbulent, which is the bad part of the risk, is only 30%, and 70% of the respondent felt that in the next 2 years, 70% there will be stability and calmness. Whereas if you look at the long term, it is 63%, which is stormy and turbulent. So 63% of the respondent felt that it would be stormy and turbulent, and only 37% felt that it would be calm and stable. So people have more confidence in the relative short term that in the next 2 years you will have more calm, but after the next 10 years, you're not really sure, and most people feel that it would be more stormy and more turbulent environment after 10 years. So for your next generation, probably it is more risky or more turbulent, which is not a very optimistic picture. So and these risks, the some of the risks that we saw, these are categorized. You can see the blue ones are economic risk. So you can see inflation and economic downturn in blue. Environmental risks are in green. So you can see extreme weather events, pollution, climate change, biodiversity, natural resource, and pollution. These are in green. Geopolitical risks, which means the risks of political differences, political issues, political conflicts across countries. All of us will know that the Ukraine Russia war broke out in 2022 January, 3 years down, still it has not stopped. Initially people thought that it would get over in a matter of a few weeks or a few days. One country is overwhelmingly powerful, the other guy will go down, but it has not happened. You have wars in the Middle East, you have civil wars in Africa. Those are running for several years at a stretch. So these are geopolitical interstate armed conflict. Societal. societal polarization, which means that people getting divided on the lines of maybe religion or language, or in US, for instance, it would be based on their political affiliations, whether they are Democrats or Republicans. So this kind of society breaking down into groups, and polarization means that they become like North Pole and South Pole. They will not talk to each other. They will not interact with each other. So this is an impact on the society. So societal polarization, lack of economic opportunities. Because of this, you would have involuntary migration. You know, voluntary migration would be if people migrate from one country to another country or one state to another state for better benefits or better standard of living or better life quality. That is a voluntary migration. Involuntary is where people are forced to migrate from one country to another because of war or an escalation conflict. You So these are, in the next 2 years, people feel that, countries feel that and pollution. People living in Delhi can definitely agree with this, that this has become a major problem, and we are not able to find solution to this, and it is affecting the productivity of the people, it is affecting the economy of the people, it is affecting the business that the companies run. So in 2 years, these are the top 10. And in the next 10 years, if you see, 2 years you can see an even spread. You have technological risk like cybersecurity and misinformation of AI. So you have a mix of all the risk categories. If you see on the left hand side block, which is the 2 year risks. But when you look at, when people thought of 10 years, these are countries and the leaders of countries, they say that in the next 10 years, there is a big shift, if you see, to climate risks. So you have extreme weather events, critical change to earth systems, biodiversity loss, natural resources may not be available, pollution. So these uh, technical technical and societal, so these have become, so the economic have actually vanished in 10 years. So people feel that inflation and economic downturn may not be such a problem after 10 years, but after 10 years, climate will be a much bigger problem than what you think it is today. Or societal polarization, or technological risks, those will become adverse outcome of AI technologies. Those could be the risks that you need to watch out for and plan for over the next 10 years. Now, some of these categories, your economic, environmental, geopolitical, societal, and technological, these risks were plotted. So these risks are plotted as bubbles. So you can see orange bubbles, the blue bubbles, the purple ones, and the green ones. The size of the bubble also changes. So the risk or the risk influence is indicated by the size of the bubble. If societal polarization is a big risk, it is shown in a big bubble. Economic downturn is a big bubble, it's a big blue bubble here. Disruptions to critical infrastructure is a slightly smaller bubble. Terrorist attack, you can see, is a very small bubble. Labor shortages, you can see below, it's a small blue bubble here, because these are things that can be mitigated. Pollution right now is a small bubble, going forward it is large. So you have about 30 of these kind of risks, and these are risks that affect not just one company or one country. These are risks that affect the entire world. Several major, small, large, developed, underdeveloped, developing. So these are risks that affect all the countries in the world. So these are the top 35 risks affecting all the countries in the world. And you can also see that there are some lines that are drawn from one bubble to another. They are all connected. So they are all it's called the global risk landscape. It's an interconnected map, which means that all these bubbles are interconnected. Societal polarization has an impact on infrastructure. This has an impact. Lack of economic activity has an impact on illicit economic activity, because if the youth or if the working population does not have economic opportunities or to earn their livelihood, they will immediately move towards illicit economic activities, which are illegal economic activities. That is again linked to unemployment. Unemployment is again linked to debt. So if there are more unemployed people, people not having a livelihood, obviously the borrowings and the debt increases. So this is very complex. This is interconnected. At the same time, one cannot ignore this, saying that this is something that is happening outside my country, not happening to me. No, this is happening everywhere. This is happening across the world. Maybe what is a big red bubble for US, which is societal polarization, may not be such a red bubble for India. It could be a smaller bubble. But all of these risks are pervasive and they are present across the countries, which is why the traditional way of looking at risks, having an ERM framework and I'll do a risk register, may not really be sufficient in today's day and age. Which is why we now come to the third part of risk management, which is, do we need to have a different approach now? Do we need to have a new approach now? uh, what framework do we follow? So it is not enough to just stand on the ground and have a telescope. You actually need to be standing on an elevated structure so that you can look far into the horizon. So what is the modern approach to managing risks? Detecting and protecting. So this will be the primary task of the ERM strategy. So effectively, the term ERM was used in the late 1990s. So it still holds good. Yeah. So again, just to recall, it is an enterprise-wide strategy for identifying and preparing for the most impactful risks that the organization faces. So this was used in the 1990s, but today, as we saw, the scope has changed. There are technical advancements and there is data proliferation. So what data was available 20 years back, it has multiplied today. So hence, so the ERM framework will have to change. So what it is today, it is important from the start to present ERM initiatives for what they are. So they are efforts to improve your risk intelligence. Employees should be able to connect with and appreciate the concept of risk intelligence. Yeah. So if you see risk, opportunity and risk are two sides of the same coin. So while an event might uh, offer a risk, it also has, if you mitigate the risk, there could be a profound opportunity available. So, how do you identify the threats to the strategy, identifying opportunities, and build organizational resilience? So, earlier it used to be risk would flow, the risk management framework would be a top down approach, more compliance centric and more compliance focused, value protecting focused. And but if you say that, okay, not top down, I will go bottom up. Bottom up, the biggest risk in going bottom up is the person at the lowest rung of the organization may not have a holistic view of what happens all across the organization, number one. And second, so these will be petty, non-impactful, non-material operational risks, and a lot of it could be reactive. So what works best would be a blended approach. So you need to have a top-down approach, and at the same time, it has to be somewhat bottoms up to make sure that you hear the voices that are there at the bottom of the pyramid. And there is also a need to modernize the risk management approach. As a second step, what we need to see is, can we look for incremental improvements? You know, which means that it is important to think of risk intelligence as a journey. So you need. So what does it involve? It involves building risk capabilities. So and this does not happen overnight. So some people believe that, you suddenly embark on a like a transformation journey. I go on an ERM journey. I commit a lot of resources to it. I suddenly change the organization. No, it doesn't work like that. These It's not a massive commitment that will tend to upset cultures that are resistant to change. So in many organizations, you will find that it's not very easy to change, and people are the most difficult to change. So change management is easier said than done. So even incremental gains in risk intelligence, so how people are able to understand that there is a risk. So the easiest way is, not to adopt an ostrich approach. So if there is a risk, let's at least understand, identify, and call it out. Yeah. So keep eyes and ears open. Don't Let's not be in denial mode, and even small incremental gains in risk intelligence. This can help in achieving the ERM framework. So think of risk intelligence as a journey and not as a destination. Begin today. So the first step is to start immediately, no matter where your organization is on the maturity spectrum. So we saw it starts from initiating, developing to a mature model. So there are some basic steps when we implement an ERM program. First is take a risk inventory, inventorize all the risks across the organization, across functions, across geographies and locations. Prioritize these risks and establish thresholds. How do we prioritize the risk? We saw how do you do a 2 by 2 matrix, the consequence multiplied by velocity. I give an objective risk score, and based on the risk score, identify your top 10, top 20 risks. Prioritize these, saying that these are the risks I would want to address as an organization, and embed risk discussions in your culture. So risk discussion should not be risky discussion. So when someone in the organization says that, oh, I see a risk here, listen to that individual, find out, okay, is that a risk? How do I assess it? Can I quantify it? Is there some way to mitigate it? And build the risk mitigation plan as part of the decision making culture. So if this is done, then that is half the journey achieved, and the organization will definitely move to success. And activate a risk monitoring program. So create your own dashboards, create your own KRIs, and build and integrate your risk KRIs with your performance KRIs. The second important aspect of this journey is to enhance internal controls to improve risk management. So just as we saw that risk and opportunity are closely connected, risk and internal control. So once you identify a risk, it is very very easy to then build a control. You could have preventive or detective controls, but it is not possible to come out and articulate or to define a control unless, as an internal auditor, you understand what is the risk involved. Yeah, so we need to start with a risk assessment, and we don't identify all the risk. So this starts with understanding what is material to the company and which processes are most important. So this is the first step. Thereafter, the next step would be to document the current processes and controls, because each of the process would have embedded controls. Identify the inefficiencies and potential gaps, and only then we can establish a step by step plan. So typically, most people get mixed up between a process and a control. A process relates to how a transaction is processed or executed, or how someone performs a certain task, whereas a control is a mechanism that is put in place to ensure that the process happens as it was designed. The second step is to have a distinction between preventive and detective controls. It is not enough only to have preventive controls, one also needs to have detective controls. They are designed to detect an error or an issue after it has occurred, but before a small problem turns into a larger one. So, early identification of gaps is something that a control framework should do. Preventive controls help prevent things from going awry in the first place. It's important to find the balance between the two. So, while ideally most of us think that, yeah, I should have always preventive controls, my control framework should be so strong that there should be no gaps, no errors, no frauds. That's theoretical. That's an ideal world, will not happen. So while you have your preventive controls, you should also have your detective controls, but which will catch the errors at an early stage. Lastly, don't let perfection get in the way. So we always hear sometimes that great is the opposite of good. So while we know that limited resources are available, both financial resources are limited, people talent, good talent is also very hard to find. Uh, and because of lack of resources, uh, we try to achieve perfection, but that's not possible. Hence, we should start with identifying the areas with most risk, the riskiest areas, prioritize those, and thereafter focus on continuous improvement. Third dimension where we as internal auditors need to wear a new hat or a new lens is cyber. And this has become more prominent post COVID. So, how do you provide a proactive and responsive cybersecurity? What are the reasons why cyber has become a major problem or a major risk today? Because you will all have the answers. Most organizations do business more and more and more online today. At an individual level, we do a lot of transactions on apps. A lot of businesses do transactions, banking transactions, procurement, sales, everything online. Several of these processes are automated. Workers, the staff work remotely. Even today, in certain industries, people have the option of having a hybrid work methodology, which means that they report to office physically office premises for some time and they work from their homes or work outside the office. So hence the vectors for cyber attacks are expanding. So under such circumstances, this gives rise to more and more cyber threats. Earlier, we saw physical assets of a company, which could be the land, which could be the plant and property, which could be the stocks and inventories. Those are physical assets. Those can be guarded. You can have security measures to protect that. You can take an insurance to protect that. But what is more difficult to protect are the information assets, which could be the emails of the company's intellectual property, client data, your ERP system, your valuable databases. So these are absolutely golden targets for cyber criminals and threat actors to exploit the business. So it's very very important what we have seen today. You could have multifarious threats because cyber hackers, so we need to be prepared for multi-front attacks. These hackers are very, very sophisticated. They are very productive and they are dangerous. They are not sitting in one country or one geography. So today, if you say that okay, somebody has to attack a plant or factory or create arson, the person has to be physically there. But a person can do a cyber attack sitting in some country or some remote corner in Eastern Europe. Need not even come anywhere close to where you are located. The threats are too many. It could be a ransomware to impersonations. So there are impersonations of CEOs, CXOs. So what happens in ransomware is uh, the organization is attacked. Some of the critical application is attacked, and they hold the information of the organization, and they say that if you do not pay up, we will leak this database in dark web, what we call dark web. So these are the kind of cyber risk. Impersonations, we may have read of cases where there are the CEO or the CFO, the image is used and you have WhatsApp messages or instructions going out from them, either in the form of a video or an audio, and people have actually lost money. So based trusting these impersonations, people believed that these were instructions from their managing directors or from their CFOs, and did financial transactions later on only to realize that there has been a fraud. Third party breaches do happen, and you also have phishing attacks. So you will have an email with a link, and that the source of the email or the sender of the email ID will look very genuine. There could be a small, the way in which the character, the alphabet A is printed could be different. There could be a different I or a different A in between. For the naked eye, it is very difficult to make out. So people just unknowingly across the organization from top to bottom end up clicking a link that comes attached. The mail looks very authentic, sender looks authentic, they click the link and gone. a lot of data is lost, valuable data is lost, and then they realize that they have been hacked. So, in fact, in the last 2 or 3 years, many companies have faced third party attacks. So not only you, if you are working with a third party service provider, it is also equally important to know how well their cybersecurity program is, how secure your data is sitting in their softwares and systems. The second step would be to assess the risk probability. So, some fundamental identity and access management. So, many of us would have heard PIM, which is privilege identity management, where the admin rights or certain privilege rights are given only to certain users or restricted to certain users. So, how the privilege identity management framework is implemented is a very critical thing. And access management, so access to the critical systems of the company should be given to the right people, and the right people should have the right access. So this, you need to have effective detection systems. So there are some fundamental identity and access management tools that are there which can be deployed to avoid a potential data breach or loss. And thirdly, in most organizations, you will have the head of IT and running with a small team, or you could have a small uh, IT support or infra support, a company that supports on the infrastructure. At the same time, cybersecurity is, the entire organization is vulnerable. All the critical applications are vulnerable. So it's very important to identify the responsibilities, because once an attack happens, it's actually shown that it takes several weeks, on an average more than 13 weeks, to even detect that a cyber attack has happened, to understand the gravity of the attack, and then third is to take protective steps uh, to make sure that there has been no damage done to the organization. One tangible step that boards and CEOs can do is to identify a list of crown jewels. Supposing there is a fire in your home or in your office, God forbid it shouldn't happen, but if there is a fire, which are the 10 things that one would protect and run? First, of course, we will save our lives, we'll run away. But before you run out of your home, would there be 5 or 10 things that you would pick up? Perhaps you would open your locker and you will take certain important documents. If you have jewelry stored, you will pull out the jewelry. You will also pull along with you key family members or anybody important in the household, and then you will run. So the first aim is to protect the crown jewels, which means these are the any critical asset of the company. So these could be customer data, these could be CRM system for a service organization. The CRM database could be a crown jewel, or the CRM application could be a crown jewel. So these are priced assets. Because these are the organization's priced assets, typically the hackers also look for these assets to attack. So it's very, very important. It could be the banking transactions of the company, it could be intellectual property rights, it could be patents that the company owns, or IPRs that the company owns. So these are crown jewels, and uh, one cannot, I cannot estimate which are the crown jewels of your organization. Each organization, they should list down which are the critical applications or what are the crown jewels. Once you know that these applications, these databases are, or these intellectual property rights or these patents are important, then you will have effective measures to protect these. So the company has to have, most large companies have a cyber security framework. They do things like VAPT, which is vulnerability assessment and penetration testing. uh, and they have an IT security policy. And uh, most important, whether you have an articulated policy or not, you need to have a set of questions. Is cybersecurity enough of a priority for the company? Do we have somebody dedicated and who is responsible for it? If and when there is a breach, what is the incident response playbook? Have we effectively protected our crown jewels? and key assets to avoid significant impact. If there is a ransomware attack, do we have a proper backup and recovery system? Can we operate resiliently through an attack and maintain the business operations? Do we have processes to address third party risk at the right frequency? Are we asking the right questions? Do we get enough information from our suppliers and third party service providers? So, some of these incident response strategy should be documented in a playbook, so that if and when do most organizations have cyber insurance? Have we taken adequate cover under cyber insurance? So some of these things are very critical issues depending on where you are, what cyber security threats the organization is facing. As an internal auditor, we need to be cognizant of this. It's absolutely not done to say that, oh, these are IT related matters, I don't understand cyber security, oh, this is too technical. No, end of it, these also have certain set of processes, and we need to ask the right questions. And as internal auditors, we need to make sure that do we even know what the organization's crown jewels are, and whether there is sufficient protection, how to do it, which tool to deploy, what kind of program to follow, how much resource to invest, which kind of partners do we engage with to carry out a cybersecurity program. These could be technical areas which you could leave it to your chief digital officer or chief information security officer. But to have an understanding and appreciation of what the cybersecurity threats are, what your crown jewel assets are, and what kind of policy that you should have. Do we have a playbook? Do we have a mitigation plan? Do we have adequate insurance? These are very fundamental questions that internal auditors must understand and ask and report. Next, we go to smart monitoring for operational risks. So there are several operational risks that the organization goes through. So we saw financial risk, and under operational in the risk universe, under operational risk we had several areas. So it could be cyber security, it could be data management, risk from artificial intelligence, outsourcing to third parties, identity and access management, technological risks, and so on. So, if you adopt new and emerging technologies like Gen AI, so these come with proprietary data and using copyrighted material without permission. So we do not know whether the data has originated from the company or it has been created by the AI tool. We do not know, but this is something that needs to be taken step by step. The second aspect of it is tap into leaders and partners. While risk monitoring capabilities have evolved a lot, they should not be left to navigate on autopilot. So you cannot say that, okay, these are my risk management programs and these will run. So every month this will happen, every quarter this will happen. uh, it's very very important that all the business leaders get involved. The board should not uh, be seeing that, oh, there is nobody in the company taking. So you do have positions like chief risk officer, and so the company as a whole should shape and manage the risk tolerance and risk approach. Finally, it's very very important to create a culture of readiness. So when you are ready to handle risk, when are you ready to handle risk? When you understand risk. So it's very important for all of us in the internal audit community to first understand business, the business operations, the market in which we operate, which are the key drivers of business. Business understanding is very, very important. Based on the business understanding, it will help us understand what are the risks involved, what are the short term risks, what are the long term risks, which are the important risks that the business has to address. As a step two, once we understand the risk, then we can go naturally to the third step of how to build a proper control environment. How do you establish a control framework of both preventive controls and detective controls? So this is very very important, and once you have a control framework, then you can do an assessment of the controls. So unless you have the understanding of business and risk, directly jumping to a control framework may not actually be effective or efficient. So, and it's very, very important that audit leaders, we should set the tone from the top. So we should make sure that operational risks don't slip through the cracks. And we should also decide on a risk posture. So, what is the risk posture of the company? And you should also pay attention to what people are saying, and be open, have a culture of openness where risk conversations happen, and document all the details, because some small detail or some small anecdote or some small reference given in one corner can actually be indicative of a larger hidden risk somewhere else. So, detect and protect. How do you achieve proactive risk management? By prioritizing business resiliency. So, first we build in business resilience, and for that we also need risk resilience. One of the easiest ways to be resilient. So, what is resilience? That is the ability to withstand or recover quickly from a difficult condition or from a difficult situation. So, when the entire world was down with COVID, how did India as a nation become resilient? So, for many of us, resilience, to assess resilience, you need to frame questions like, what are we going to do if something happens? Yeah. uh, all of us must have heard of NASA. So they put uh, spacecrafts into space, and they have the world's most complex space program. However, they also have a network of sensors that will detect if something is wrong, and there is a contingency plan for every error code that comes up. So in the context of running a business, resilience means, not you should not only have a playbook for material disruptions and threats that could impact the business, but also have and cultivate a culture of resilience. So every meaningful decision is viewed. So you need to have a culture of resilience. So it is not only organizational resilience, it is also people resilience, it is reputational resilience, financial resilience, and environmental resilience. So earlier we would have seen that the focus was more on BCP. From business continuity, you move to building agility and building an agile and learning organization which can thrive in the face of disruption. Just like cyber security, resilience also involves which posture to assume. So, what is the right posture for a given point in time? So, it is not that you have one resilience posture for all points in time. At this moment, what is right for the company? So, it would depend on the prevailing market conditions, what the internal and external resources are, what is the state of the overall business health. So you could have, there are four kinds of resilience postures. On the operational side, you could have an operational defense, where it's a defensive approach to transform certain isolated or specific parts of the business. Or you could have an operational defense, which is a crisis management position that empowers the at risk function of the organization to swiftly recover, usually again in an isolated pocket. An organizational offense, which means this is an offensive posture at an organizational level. It's a cross functional, enterprise wide strategic priority that continually looks to transform the full spectrum of the business. And organizational defense is an enterprise wide coordination to prepare for crisis and disruptions. So, how do you know what is the right posture for the moment in hand? Sometimes it's pretty obvious. For instance, uh, if the main focus of the company is operational, to sell the goods, then product innovation will not appear on top of the agenda. So, if the production facility is flooded, or if there is a fire in one of the major factories, then the posture would be operational defense. So you will need to contain and mitigate the problem in a particular pocket. But most of the time, deciding what posture should the organization take It does not immediately reveal. So over a period of time, when things start to unfold, then you say, okay, should I take a offensive posture? Should I be defensive? And so on. It also depends on what the market conditions are, what are the competitive threats. Yeah. So, two main questions that we can start with is, what are the severe but plausible risks? So, the risk could be severe, but it is plausible that it could happen, which will affect us. And what is our ability to respond and adapt to that situation? So, what is the risk that we foresee that is likely to occur? And what is the organization's capability to respond and adapt to that situation? So, this will provide clues for what kind of a posture an organization should take. Finally, we need to remember that resilience is not a process; it's a way of being. Yeah. So it's very important to have an understanding of the business relative strengths, what its risk aversions are, what is the risk appetite of the organization, what are its capabilities, what are the capability gaps that we have. Once we have a proper understanding of that, then we can install internal controls. The control system should be so robust that it should notify and activate the organizations when those risks are triggered. So, if there is any event that triggers a risk, then the control framework should immediately send notifications across the organization for actions. And ultimately, this will decide how the business responds to a certain situation. So, this is how businesses build resiliency. For instance, couple of 2 to 3 decades back, we may recall that there was a lot of focus on quality. So in India, most organizations were used to not having very high quality standards, but to improve the quality standards of our products and services, people started to look in which direction? Far East. So everybody looked at Japan. There was a focus on TQM movement. So Japan had the total quality movement, Six Sigma, it had 5S, it had Lean. Several large Japanese corporations like Honda, Toyota, these were leaders in quality movements. And it not only started in a tiny country like Japan, it actually moved over and spread across the world and had a huge following in the United States. So USA adopted, Europe adopted, the Western nations adopted all of these qualities. So at that time, quality was more like a mantra. Every company, then India started to follow suit. So that was a global movement. Much in the same way, resilience can also evolve and emerge to the point where it is embedded in our business operations. So when we say that we are building resilient organizations, I think all we are doing is just scratch the surface. But as we keep doing it repetitively, as we record the learnings, as the learnings get communicated and cascaded across the company, we build greater risk intelligence. And this risk intelligence will give us the confidence in our ability to deal with situation when the next evolution of risk is triggered, no matter what comes. So, this is how, in a step by step way, businesses build risk intelligence. From risk intelligence, they build the resilience, and from the business resilience comes the confidence to the people, to the functions, and to the overall organization as to how it will be able to face risks in a resilient manner and come out of it and able to mitigate the risk and come out of it with greater and greater success. So, this is what we can do by adopting some of the new features, some of the new processes, some of the new practices, moving away from the traditional to building a risk intelligent and a risk resilient organization. Thank you, friends. Uh, we are open for questions. Do we have any audience questions here? Yeah, can you please read out the question? Uh, am I audible? Could you please read out the question? I can't read it in full. Mm, okay, so in terms of prioritizing risk to giving a score, so you have the risk. So each of these risks, for example, if you look at a supply chain risk, not able to source your raw materials on time. So you have imported raw materials and which are in limited supply. So getting your raw materials in time for production is a risk. And if you have had a past experience of stockouts, so you can say what is the frequency or how likely it is to happen. So you can give a score ranging from six and six on each side. So you could have a 6 by 6 on a score of 36. You can say, okay, my score will be 24 or 30 for getting raw materials in time for production facility. And how does it impact? So this will have a short term impact. So on the velocity, you can give again on a score of 5 or 6, you can give a score of 2 or 3. Multiply the two, you will get a score of 50. The second example could be on the front of recruitment, let's say. So if your business is very people oriented, it's a customer service driven business, then getting your recruitment of people on time is very important. So if you are not able to hire your talent in time as per your business plan, how much of revenue would be lost, how business critical that risk is. Again, you can give a score of 4 out of 5. How likely it is to happen, you can give a score of maybe 3 out of 5. So out of 25, you would have a score of 12. And but this risk will have a short term impact as well as a long term impact, because it will impact the business and the market share. So you can give a higher score on velocity. So on velocity, you could have a score of 4 out of 5, so it will have a score of 48 out of 100. So that's how you give scores across various risks. It could be people risk, production risk, client risk. So you give the scores, and then prioritizing happens based on the scores. The second question was how ERM is relevant in financial audit and financial reporting. Has role of CA expanded to management as well? Yes, of course. I would consider CA as an integral part of a finance function, and hence a part of management. And enterprise risk management is relevant in financial reporting at first stage and financial audit in the second stage. In reporting, you need to have adequate controls to ensure that your financial reporting is as per the accounting standards. So whether you're reporting and recording all the transactions correctly in your accounting system or ERP framework. Second, are your estimates right? Are your accounting standards being followed? So this is also part of the overall enterprise risk. Enterprise risk would also have reporting risk. So if incorrect financial data is reported, it has two consequences. One, it's a regulatory challenge, and second, all the decisions are done by the company based on the financial numbers. So if the numbers are not reported right, it is a huge risk. So that is how ERM is very, very relevant. It's important to ensure that your numbers that you report and the disclosures that you do are proper. I hope that answers the question.